Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we are coming to you live as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant with me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi guys. It's only Tuesday. Feels like we've done longer in the week, right? But no, it's only the second day of the week. But it's been busy. I mean, lots of earnings, trade headlines, tariff headlines are back. And we have plenty to go over, Nigel.
Well, that's right. You know, the market action itself has been a little bit subdued. But I'll tell you what, at times like these, that's when you get stocks at the prices you want to. And it's been in a bit of a tizzy and no signs of any big reversal. But maybe a bit of a subdued market could be a blessing to some because the pace that we went up was very, very swift and many people missed out. So maybe, in fact, that chance is now being presented.
Well, many chances, right? I mean, but the point is you need some consolidation.
Yeah.
You need some slow is good. I mean, otherwise fast-paced rallies, rip-roaring rallies. That's essentially what we've had over the last few years, and it's not a very short-term kind of phenomenon. Let's just take it from the top in terms of what you need to know. So trade tariff headlines, of course, top of mind as the 1st of August deadline comes through. That's it. I mean, that's the big one, really. Will we see a deal, an interim deal before the 1st of August? If not, on the post the 31st of July, what happens? Will the rate reset to 15%, 20%, etc., etc.? So it's not just India, right? I mean, there's Korea, there's Taiwan. So 3 countries, Korea, Taiwan, and India. So that's about 10% of US imports, all essentially in line for some sort of a potential deal. Tariff uncertainty, of course, also regarding tariff rates on currently exempt sectors. And by the way, this is Section 232. This is separate. And Trump and his team have said that those investigations are also concluding. And around the 1st of August, we should be able to declare what our tariffs are on things like pharma and semiconductors and a host of other things as well. We'll see, even with regards to US-EU deal, I saw a few stories which kind of said, well, it looks like the US side agreed on something and the EU side agreed on, of course, I mean, some of the common things, but there were also kind of disagreements which were creeping up. So what exactly is going to be the deal which was agreed upon? That is still not entirely clear. To a large degree, yes, but not entirely. US equities, they were flat. S&P, nothing very much. NASDAQ was up about 1/3%. Big move in the US dollar, which is about 1% higher, about 99 or so is where the US dollar, almost 99 actually. Oil prices were up 3%. We are at about 70.4. And this is, of course, on the back of President Trump, who's sort of brought forward the deadline for Russia to reach a ceasefire agreement with Ukraine. I think he's now saying 10, 12 days, and he wants an agreement on the table. So we'll see where this one goes more later. Now, here in India, many, if you look at the Nifty Bank, broader market, small caps, for example, losing streak, many short-term market indicators are suggesting that we are in a oversold kind of a zone. But, oversold does not necessarily mean immediate kind of turnaround, but does it does sort of warn you to be careful if you are trading on the negative side, if you're shorting, etc. A positive daily close is the first sort of, requirement before we start to say that whether this decline is complete or not. So on both the Nifty and the Nifty Bank. The next big support level, because, most levels are gone now, is 24,450 to 24,500. This is the next sort of major support zone that we'll work with. Bank Nifty broke the previous low, which it did not do last Friday, but yesterday it did. And here the support zone is 55,475 to 55,150 or so. Those levels should come up on your screen, 55,475 to 55,150. No real immediate near-term triggers, nothing with regards to, a sector which is suddenly going to sort of take leadership, take charge and, guide this turnaround. But things emerge eventually, gradually, out of declines as well. So we'll just have to be patient for that. GIFT Nifty implying about a 50-odd point lower start once again this morning. Surabhi.
Yeah, absolutely. And, last couple of days, we had great global cues, global markets rallying, and still we kept falling, on our own weight or under our own weight. This is a slightly different morning because you don't have so much of tariff exuberance or trade deal cheer. A lot of markets are cooling off. That happened on Wall Street, and that's happening across Asia as well because many of the markets like Japan, even the Hong Kong Hang Seng, they're down 1%. So global markets in a bit of a sell-off, profit-taking mood this morning. So let's see how that plays out for us. Now, the trade headlines are actually not very encouraging for India. Of course, we're still, waiting to see if some kind of an interim deal will be arrived at before the August 1 deadline. But see what President Trump has said on a whole host of factors overnight. And none of it sounds very positive for India. Number one, he's talking about a baseline tariff of now anywhere between 15% to 20%. Which is going to be substantially higher than the 20%, than the 10% that was prevailing right now, for all countries that don't make a deal by 1st of August. So that's caution number one. Number two, he's talking about imposing additional tariffs on Russia's trading partner. This 2-week window that he's given to Russia to arrive at a ceasefire with Ukraine, if the ceasefire doesn't happen, then what is his counter threat? He's saying anyone who's trading with Russia, buying Russian, inputs, and of course that would include Russian oil, will be slammed with a 100% additional tariff. The next or the third negative headline on the trade front is coming in on pharma. On pharma, he's saying that we'll be announcing something on pharma very soon. We have a big plan on pharmaceuticals. We want to bring pharmaceuticals back to America. So again, it's a lot of chatter, a lot of noise, but all the noise is not very conducive just in terms of sentiment for us. What's also not conducive is some of the macro numbers that we got yesterday, and I'm talking about IIP. IIP is at a 10-month low. The number for June is, 1.5%, slightly better than 1.2% month on month. But again, it's subdued. It's also the monsoon effect kicking in. So sectors like electricity, pretty weak, mining pretty weak. Manufacturing sequentially has seen some improvement. Manufacturing output slightly higher. But again, not perhaps enough to really light up the street with excitement. Let's talk about the flows. Now, Nifty has been continuing to drift lower. Again, yesterday, the boundaries have gone and we're constantly drifting lower. No real positive earnings spark, and there's constant FPI selling, which is why we ended at the day's low yesterday. So it doesn't inspire much confidence. Yesterday, the net numbers are very big in the cash market, actually. Look at this, 6,000 crores, 6,100 crores of FPI selling almost, countered with huge amount of DII buying, almost 6,770 crores of DII buying, but overall big numbers coming in. Stocks. Well, IndusInd Bank, the best thing is that there's no major negative, fresh headache at least. In fact, some of the numbers like the NII number, the profit number, they're above the pole. Though, of course, year on year, those numbers still will be very, very weak, as you can imagine. Slippages sequentially have come down. They're still very high slippages. 2,500 crores of slippages versus, 5,000 crores when they did the whole cleanup. So we'll see how the market feels about it. The thing is, it's not anything immediately positive in the IndusInd Bank numbers either. Look at Masgao now. Remember, yesterday we were talking about negative numbers from defense companies. Add one more to the list. For Masgao, it's been a challenging quarter. EBITDA is down 50+%. Margins have fallen quite a bit. Revenue is up about 10-11%. Adds to the list of Paras Defense, Zentech. These are lumpy businesses. Doesn't seem to be a very good quarter for Masgao. Today's results diary, and we've got some big names coming in over here. There's L&T, there's NTPC, there's Asian Paints, and from the mid-cap space, lots of names, including some of the interesting ones like Amber, Varun Beverages. It's a full slate of earnings. Let's see if we'll get any earnings surprise, pleasant surprise, or earnings star. We've been missing one for a while. Nigel.
Well, precisely, Surbhi. That positive trigger actually has been missing with regard to earnings, with regard to fundamentals on ground as well, and various data points that are coming out. As you mentioned, IIP, various production numbers, demand in terms of electricity as well as power, they're a little bit softish, even taking into account that it's in a monsoon season if you compare it on a like-to-like basis. The last one, the price action has been disappointing, right? Because we've been down close to around 4% or thereabouts, and India has relatively underperformed. But keep in mind, this fall is coming on lower volumes because you just pull up the chart. Last couple of months, the average volumes for July itself has been quite subdued in comparison to what we have seen in June. So sharply lower out there. This is the NSE volume number that we're looking at in value terms. And yesterday's volume, in fact, was even lower than what we have seen on an average. So the short point is this fall is coming on subdued volumes. It's not coming on very, very large volumes, which could be some bit of a comforting factor. Moving to the other cues that we have, the rollovers. Well, the Nifty rollover is only around 45%. Normally on D-3, that is 3 days before expiry, it's normally in the vicinity of around 51%. So Nifty rollovers are yet to take place, while the Nifty Bank, well, that's more or less in line at around 36%. What did the FIs do? No prizes for guessing. They added shorts yet again. 8,500 short contracts, 4 shorts added for every 1 long position, and now the short positioning is at around 85%. And, if you just look at the screen, you'll see that the short positioning has moved up. So we started the series at around 40,000 contracts from the FIs on the short side. That number has ballooned up now. That's moved to around 1.65 lakh contracts on the short side itself, and that's the highest we have seen since March 2025. The PCR as well has come down to around 0.64. Normally, the combination of both these two factors indicate that a short covering bounce is due, because the PCR is already below the lower end of the range or closer to the lower end of the range, while the FI net shorts as well at peak, they were closer to around 2 lakh contracts. So that as well is getting there. The only problem is we've got an expiry that's coming out. So maybe, in fact, that short covering bounce that's anticipated is not as swift as we would have liked. But we need to keep an eye out on that front. And the reason that the PCR has moved down because the call writers, well, they believe they've got this covered on the upside. 24,700 call, 24,800 call. Between them, they added close to around 1.1 lakh shares on the short side. So that's the aggressive call writing that we're seeing. And just going by these data points, the kind of call writing that we're seeing, in the near term, that ceiling for the market is gradually coming down. And the bears believe they will be able to defend this 24,850 odd mark, that in terms of a resistance level that we're looking at, while the crucial support, 24,850, 24,900. That's the resistance. But the crucial support is around 24,500, 24,550. And, I spoke to various traders, various people who read the F&O data very closely. They said this is the line in the sand. This is the important mark. And even the options data is indicating that if you need to see a short covering bounce, well, it needs to come before we get to those levels, and we cannot breach those levels. The problem is the Nifty Bank that was holding one end up. Yesterday, it ended below the 20 as well as the 50 DMA. So that, in fact, needs to get back up towards those crucial technical levels. So a short covering bounce is due, going by the technical indicators. The markets are lacking that positive trigger. But maybe I think in the next couple of trading sessions, that relief rally should be due, though the structure is punctured for the time being.
Okay, well, many short-term indicators in the oversold zone. Nigel, thanks for that. Mark Matthews is with us of Bank Julius Baer and Company. Mark, great to have you with us here. Good morning. Thanks very much for your time. Just a quick word, Mark, on whether ahead of the tariff deadline, how should we see this? Because now this is the firm one. There's no extension. The US side has said again repeatedly. And he said, well, if for countries where we don't reach a deal, we're going to settle between 15 and 20%. I think all inclusive. I mean, that's not 10% base plus 15 or 20. I think 15 or 20 all inclusive. What's your sense, Mark?
My sense is that it's not material. The market's making a mountain out of a molehill. Exports to the US from India are 1% of India's GDP. If you include services, it's 5% of GDP. That's small. I mean, for Canada or Mexico, then this is a big concern because they're around 20 and 30% of their GDPs respectively. But clearly the market likes talking about it, and it's a big sentimental issue. And I think the more concerning thing, just eavesdropping on your conversation earlier, is the idea that President Trump is unhappy with what's going on in Ukraine. He wants a ceasefire. It's not happening. Doesn't look like it's going to happen. And so he's going to indirectly ratchet up sanctions on Russia through its intermediaries, of which India is a big one. And that threat of a 100% tariff on countries which do business with Russia is, I think, a more material concern.
Absolutely. So we have the next couple of tentative days, Mark, coming in. We need to see if we get a deal or not. And if that doesn't happen, does India's baseline tariff move up in the interim? And then this whole specter of the ceasefire window, a 2-week window that he's given. How should we interpret the potential implications? Because it's all up in the air. that he's going to levy 100% tariffs on those who are trading with Russia. So what should one be prepared for, I mean, from an Indian perspective?
On the one hand, I think India is an extremely critical ally to the United States for many obvious reasons, not the least of which is its importance in Asia as China becomes the paramount competitor to the United States, both militarily and economically. So the Americans should want to keep India in their good graces. But on the other hand, there is this situation with Ukraine. And frankly, I've become very fatigued at trying to predict what Donald Trump's going to do. I don't know what he's going to do. I think he could very well impose sanctions on Russia that would boomerang on India, and that could take the market down. I don't want to deny it's a potential, but on the other hand, as I said, India is an important ally of America, and so I don't know which one he'll do. I suppose I would err on the side of him being nice to India for the reasons that I just stated.
Hi, Mark. Good to see you. Ben, the Indian markets have gone through a bit of a lull period and a relative underperformance, but that sometimes gives you buying opportunities. Do you think, say, in the next 12 months from here on, as we discussed last time, the Indian markets could be higher, maybe a double-digit return from here? And also, since we're going through this sideways consolidation phase, what would you look to buy in India?
The sector that looks most interesting to me is the IT sector, because it's the sector that's performed worst this year. And normally it's not a good idea to catch a falling knife, but there are some valuations there which are just too cheap in my mind. And I don't know why the street didn't like the most recent results. I really didn't think they were bad. And I thought the commentary from management going forward was more positive than I'd been expecting. So I think that is the opportunity. Banks have been, of course, the best sector so far this year. Now they're taking a breather, but they're still not expensive despite this great run, because they're clocking very good numbers. And so those would be two, and maybe the consumption sector, just because 1 lakh crore of tax breaks will definitely help the consumer, as well as the 100 basis points of cuts we've had from the RBI over the last few months. So those are the three that we like.
Okay, interesting. So giving a thumbs up to Indian IT. Not too many people that are doing that at this point in time. That's an interesting call. Thank you, Mark, very much for joining in. Always good chatting with you. You have a great day, and we look forward to connecting again soon. Well, that's a view coming in on the global setup. Let's tell you what are the other interactions lined up on the show today. At 8:35, we get chatting with the management of SAIL, talk about the company's Q1 performance and the outlook. At 9 o'clock, we'll have Vijay Agrawal of Aquarius joining in to talk about some of the key trends in the real estate sector. And to answer the question, is the IT sector slowdown, will that spill over in the real estate sector? Rana Gupta of Manulife Investment Management is our market master of the day. He joins in at 9:20 a.m. At 9:30, we get chatting with KEC International, talk about the company's Q1 performance, which has been fairly steady. Mr. Vimal Kejriwal will join in. After that, we'll be in conversation with the management of TTK Prestige. It's been a rough quarter for TTK, rough start to the year. Will it get better in the second half? Let's find out. 9:40, that is when that conversation is coming up. And at about 9:50 a.m., Vinay Rustagi of Premier Energies joins in to talk about the company's Q1 earnings and the outlook going forward. Towards the end of the show, Lata will be in conversation with the management of Bank of Baroda and talk about some of the important trends, including asset quality and margin outlook for the rest of the year.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you today. We get to that in just a bit in our special Top 10 segment. We're looking at Torrent Pharma, KEC, NTPC Green, Vari Energies. We've got Paradeep Phosphates. All of them will be reacting to positive news flow. And today we're split down the middle with 5 likely to react to positive news flow, while we have IndusInd Bank, Gail, Torrent Pharma, Marscon Dock, and RealTel that will be reacting to negative news flow. Slip into that break, come back, get into further detail on all of these names.
Welcome back. Let's get to a lot of the stocks that we have to look at. Remember, the cues, overall are a little negative, and the implied open is anyway indicating that we'll start another 50 points lower from where we are. Most of Asian markets are down between 0.5% to 1%. Okay, let's look at stocks then. Our team is standing by with the list of top stocks to watch this Tuesday morning. Guys, morning to all of you. Gaurav, let's start first with IDFC Bank. What's your verdict?
Well, when it comes to IDFC Bank, weak set of number is what we were expecting, and the bank has delivered weak set of numbers. Rather, we could say a better number than what the street was expecting, because net interest income that declined only by 14% versus the street's expectation of 22% decline. When it comes to net interest margins, there also we saw bank deliver 3.46% of net interest margins. Now there is an impact of 11 basis point of a one-off, but even if we exclude that, NIMs were better. When it comes to operating profit, that declined only by 35%, and profit now that has declined by 72% versus the expectation of around 75% fall. When it comes to the asset quality, now this quarter credit cost and slippages, they both have remained elevated, but they have declined on a sequential basis, which was a little bit of positive. But what remains a key trigger here is that there were no near-term commentary which could suggest that the ROAs are going to go above 1%, and that is the reason why we are seeing some kind of pessimistic view from brokerages here. So we have got JP Morgan, who believes that the operating profit is likely to stay subdued for the next 3 years. Other than that, Macquarie also believes that the ROA is likely to remain below 1%. And Bernstein, they also noted that with this set of results, there will be a reassessment of near-term ROAs, and that is something which is concerning. When it comes to commentary, we did not see any kind of positive commentary, because the lack of triggers is something which we are seeing in the result of IDFC Bank right now, and as a result, we will be watching out of this stock today.
Okay, all right, Gaurav, thanks a lot for that. Well, let's hop across to Sonal. She's here to tell us about Gail, who reported their numbers. Hey, Sonal, morning.
Good morning, Nigel. Well, Gail reported numbers which were a mild miss to already muted expectations. So if we look at the standalone numbers, revenues down 3%. EBITDA came in flat at 3,200 crore rupees, which compares with a poll of 3,389 crore rupees. Profits were down 8% to come in at 1,886 crore rupees. The poll was closer to 2,000 crore rupees. In the EBITDA, there has been an adjustment for a one-time income of 133 crore rupees. Strip of that, the numbers look like this. If we talk about which are the segments which led to this fall, so it's the petchem business where losses widen, and also the LPG business where EBIT is lower than what the street was working with. Transmission did well, EBIT up 21%. Natural gas marketing in line with expectations where EBIT was down 11%. But as I said, petchem EBIT loss has only expanded on a quarter-on-quarter basis. And LPG as well, EBIT was down 29%. Also, the volumes were lower than what the street was working with. We have a conference call. The management has a conference call at 11 a.m. So we'll get more details on this one.
Okay, all right. Gail in focus. Stock perhaps opens a little lower. Mazgaon is the next one we're going to focus on. Upasna has got details here. Upasna, morning.
Good morning. Well, overall, if we see, it's a weak result. Revenue saw an uptick of 11% on YoY basis, but sequentially, it's a decline of 17%. EBITDA saw a decline of 53% on a YoY basis, leading to EBITDA margins dipped almost 1,575 basis points at 27.2%. Now, net profit stood at 696 crore with a downtick of nearly about 35%. Now, this is because of the higher other expenses. Now, in terms of other expenses, the company's subcontracting expenses stood at 194 crore with an uptick of 9% on a YoY basis, leading to the overall miss on terms of net profitability. Other expenses have also impacted the profitability of the company, such as other projects which related expenses, which jumped almost 13 times on a YoY basis, and company's provisions also inched up higher at 540 crore in Q1 FY26. Now, sequentially, subcontracting expenses is down 67%. Other project expenses and provisions all remain elevated. So, overall, if we see, all these factors have impacted the profitability of the company and overall performance.
Oh, yeah, absolutely. A huge rise in their expenses on various fronts. Thanks for that, Upasna. Like I was saying, that after Zen and Paras Defense, one more defense company that's disappointed just in terms of the P&L. Let's move on then. We've got a couple of pharma numbers to look at as well. And Ekta is joining in with the latest. Morning, Ekta.
Morning. I'll start with Torrent Pharma, which came out with what was an inline set of numbers. So the revenue was up around 11% odd, the margins at around 31%, and we had the profit, which was up around 9% year-on-year as well. Now, in terms of the geographies, what stood out was the double-digit growth that we saw in India, US, as well as Brazil. So India was up 11% year-on-year, US was up 16% to $36 million, and Brazil was up around 11% as well. Now, for Piramal, it was a disappointing set of numbers, you would have to say, this time. So the revenue growth was, just about flat this time. We had the margins, which came in at 5.5 versus 26.9% Q-on-Q and versus 10.5% year-on-year. And the profit, it was a loss of around 81.7 crores. The CDMO segment declined 6%. The complex hospital generics, which is basically inhalation anesthesia, was flat. Consumer healthcare did well. It was up around 15%. They're sticking with their FY30 aspirations of being a $2 billion company with 25% margins. But nonetheless, for today, I expect the stock to possibly be under pressure.
Got it. Okay, all right. This one under pressure. Piramal Pharma went dancing away to nearly 300, now back down to around 200, and the numbers fairly disappointing. Vivek joins in though to tell us about KEC International. Morning, Viv.
Good morning. Well, KEC International, all eyes, will be on the entire infra space today. Also, L&T goes ahead and declares its results later today, and all eyes will be from the order inflow from the Middle East. So, KEC International, steady quarter. However, on a year-on-year basis, the order inflow has dipped. This is because the company comes off a very high base as far as order activity was concerned. Margins, the key figure to watch out for, EBITDA margins, while it has actually expanded on a year-on-year basis, it continues to remain below the management guided range. So let's have a look at the numbers. Revenues higher by 11%, coming in over 5,020 crore mark. However, if you're looking at the management guidance, 15% revenue uptake is what the company had guided for FY26. EBITDA up 19% at 350 crore. EBITDA margins at 7%, still below the guided range of 8 to 8.5%. Profitability on the back of the improved execution has gone higher by almost 42%. Order book plus L1 position of the company stands at 40,000 crore. The tenders under evaluation, or the tender pipeline as the company calls it, is at close to 1.8 lakh crore. YTD order intake, like we mentioned, off a higher base, is down 28%, but still quite healthy at over 5,500 crore rupees. It will be important to watch what the management says in terms of margin trajectory, and also what are the prospects, especially as far as Middle East is concerned, and also what are the collections the company is seeing from the water vertical, which for the past few quarters was under pressure.
And we'll ask all of those questions, Vivek. Vimal Kejriwal is going to be with us at KEC. That's at 9:30. That's the conversation. First up after market opens. But Vivek, back to you. NTPC Green, Vari Energy, lots of numbers.
Well, that's right. If you're looking at the power vertical, so NTPC Green, the renewable energy arm of NTPC, delivered its numbers. Good set of numbers. Revenues higher by 17.5% on a year-on-year basis. EBITDA, again, following the revenue trajectory, almost 18% higher. EBITDA margins flat, very healthy at over 88.5%. Net profit higher by 59%. Other income component aided the PAT, almost at 71.5 crore, versus just 30 crore last time around. What did the company do as far as Q1 was concerned? Almost 800 megawatt commissioning was seen. Total operational capacity for NTPC Green stands at almost 7 gigawatt. Remember, the company is targeting close to 7.2 gigawatt of commissioning in FY26, and the company has very lofty targets as far as FY30 is concerned. Now, coming to Vari Energy, in line with its peer, Premier Energy, very healthy set of numbers. Revenues higher by 30%, coming in at over 4,400 crore. EBITDA higher by 80%, coming close to the 1,000 crore mark. When you're talking about the EBITDA margins, very healthy over here again, 22.5% versus 16.2%. Profitability higher by 92.5%, again aided by healthy other income. Now, the company has given a very strong guidance for EBITDA as far as FY26 is concerned. They are guiding for EBITDA in the range of 5,500 to 6,000 crore rupees. Order book of almost 25 gigawatt at 49,000 crore rupees, of which exports are at over 41%. Now, that will be the key figure to watch out for, given the fact that there have been various negative commentary coming in from the US, especially in terms of solar panel installations. Also, the company has gone ahead and articulated its FY27 target in terms of capacity, cell target at over 15 gigawatt, module target at over 25.5 gigawatt, and an ingot wafer target at around 10 gigawatt. Again, expect both of these stocks to open in the green today.
Yeah, absolutely. I mean, Vari and Premier both have done well, and not Vari, but Premier will speak to today for sure at around 9:50. That's a conversation coming up. Find out how some of these renewable players are looking at their businesses. So that's NTPC Green, which has also had a very good quarter, as Vivek just outlined. Let's quickly move on. Vinny is looking at some numbers for us as well. I think Railtel Corp, Paradeep Phosphate, and I don't know what else. Vinny, good morning.
Only these two names would be good morning. So firstly, talking about Railtel Corp, numbers, when you're looking at it in terms of revenue, 33% growth, I beg your pardon. Now, that is obviously much better than what the street was expecting or analysts were expecting as well. So it's coming at around 745 crores. Profits, good growth in that terms as well, 36% there. Now, the miss comes in on the margin front. The margins, EBITDA margin have come in at 15.6% versus 18% last year, 18.5%. So a sharp contraction in terms of margins. What has led to this? When you're looking at it, your telecom service revenue, that's seen a growth of just 2%, which is a better margin business for the company, while projects business for the company, project work services is what they call it, that's seen a growth of 77%. So that suddenly become a growth driver, which is a lower margin business. So the change in terms of that mix is something that's impacting the margins of the company. So a bit of a red is what we could watch out for on the screens for Railtel. Now, other than that, Paradeep Phosphate, in terms of numbers, good performance that's coming in from the company in terms of profits of the company, sharp growth there. Revenue seeing around a 60% uptick as well. And margins, that's also seen a sharp expansion there, 12.4% versus 6% just last year. So good performance there. We could see green coming in for this stock today.
Okay, all right. Thanks very much. I'm sure the street is going to be happy seeing some green. Vinny, thank you for that. Let's quickly recap our list of stocks to watch this morning. The ones that have positive news flow around them are Torrent Pharma, KC International, NTPC Green, Wari Energies, and Paradeep Phosphates. Stocks with negative news flow would be IDFC Bank, Gail, Piramal Pharma, Masgaon Dock Shipbuilders, and Railtel Corporation.
Okay, all right, let's turn our attention away then from the equity markets. Manisha Gupta joins us to tell us what's going on in the commodity space. Morning, Manisha.
Morning, Nigel, and thank you for that. Well, it is about the U.S. and European Union trade accord that has lifted risk sentiment. The U.S.-China trade talks will also resume. Dollar index, in the meanwhile, is trading at a one-week high. And the U.S. Fed two-day meeting starts today. While we're expecting the interest rates not to change, but it really is going to be about tone, guidance, and what the U.S. Fed chair says that is going to impact the market. So in light of all of that, there is a decline that we've seen in case of gold prices. That one is trading at a three-week low. Silver prices have declined 2% overnight. If you look at other metal prices, we've seen U.S. copper decline by 3%, and the LME copper also has seen a decline. That one is trading at a one-week lows as well. This is especially ahead of the August 1 tariff deadline, where the markets are awaiting more clarity on the tariffs. But copper is not the only one. Zinc is off its 4-month highs. Aluminum prices are off its 4-month highs. We also are looking at steel prices seeing a bit of a decline as well. So metals, after that very strong the month of July, have gone in for some profit taking. The only thing green that I see on the screen clearly is the crude oil prices. 2% of gains overnight. It's trading at a one-week highs. The Brent crude prices are back above $70 a barrel. Trump has now cut Russia's time and has given 10 to 12 days to agree to a ceasefire or face sanctions. That exactly is the premium that we are seeing in case of prices. Markets also will continue to watch out for the U.S. jobs data. That's going to be the next deciding factor for the interest rates and the way the dollar index will move.
Thanks a lot, Manisha, for joining in and filling us in with all of those cues. Also, an interesting point with regard to the coking coal prices in China. That's come down for the second day running, and there is pressure out there. The key reason is actually that we have steel production in China that's coming down. Normally, you would say that's a positive, right? Because steel production is coming down. But because of that, you have coking coal costs as well that are moving down, which for an Indian steel producer, actually, it's a positive. However, the problem is if Chinese production is coming down and the input cost is going down, that's what will put pressure on steel prices as well on the global front. And as we know, that in turn could reflect in lower prices here in India as well. Talking about the steel industry though, SAIL, that's the first management on the show. Remember, the company reported actually a softish set of numbers in the first quarter. They missed what the street was working with. I caught up with the company's CMD, Mr. Amrindu Prakash, and I quizzed him about the soft showing in the first quarter and also asked him, what's the way ahead? Let's listen in to what he had to tell me.
From the street expectations to the actual numbers, there is only one gap. The gap is in stock valuation impact. CPLY, we have had a stock valuation impact of 1,080 crores. Even if I say normal inventory of 500 to 600 crores, the 500 crores number which has gone out because of stock valuation is the only change. And this is just an accounting entry affecting us only for this quarter. So the year projections remain strong, remain positive. In fact, this stock valuation impact also indicates that we have brought down our cost, and because the inventory is valued at cost, so that's why this hit has come. But it gives us confidence that our cost reduction measures are working.
Got it. All right. Let's take it now piece by piece. We take forward your clarification on board. What is the volume growth you're looking at for this year? If you could quantify it.
Yes, we have planned a volume growth of 8% CPLY.
Okay, so you're confident, because the last time around you had mentioned about 8%, but now you're confident that you can achieve that. Now, since you're saying that this valuation impact is just for the past quarter and things will look up from here on, let's dissect it a little bit. What about realizations? In quarter two, ideally it should be softish because of the monsoon. How do you see realizations move for the coming quarter? And also, if you look at the cost of coal, what was the fluctuating between quarter four and quarter one? And in quarter two, how will it compare to quarter one?
So, coking coal costs have been range bound. So, if we look at Q4 and Q1, there is not much to pick up on. It has remained stable. Going forward, also, we see the same trend continuing. There is no fundamental factor which should affect coal price going forward. So, profitability going forward will depend on two things. One thing is volume, and second thing will be the cost efficiencies that we accrue, which are sustainable. Both, as I said, we are planning a overall volume growth of 8%, which we are confident of achieving, as well as the cost reduction, which I said has worked. If I compare with previous year Q1, the costs are better now through efficiency. And this push we are going to continue. Another factor which is coming in is we have commissioned a program to improve our digital presence. The implementation of Industry 4.0 in our operations is ongoing. We have taken a target of adding 1,000 crore per annum to the bottom line purely with our digital initiatives. So this will go on accumulating as we go forward in this year. 1,000
crores to the PAT number because of digital initiatives?
PBT number, because purely on account of this. In fact, the program we are working on, the payments are linked to actually achieving these numbers. If these numbers are not achieved, no payment will be there.
No, that'll be interesting, and we'll track you on that one, sir. But since you're focusing on the cost efficiencies, and there's going to be volume growth as well, according to your calculations on an EBITDA per ton basis, what number are you satisfied at?
See, but we look at currently 10 point something number in this quarter. If I take out the valuation impact from next quarter onwards, it should automatically jump up by 2 to 3%, and a further 2 to 3% I'm confident can come from the cost numbers.
All right. So instead of EBITDA per ton, you're giving me the margin number. Last quarter, it was in the vicinity of around 10%. In the coming quarter, it could improve by around 200 to 300 basis points, and post that another 200 to 300 basis points in the second half of the year. So ballpark, in margins, are going to be moving from around 10% to more than 15% by the time we wind up the year. Got that. One positive in the numbers actually was your net debt number. You know, in the last few quarters, it's gradually been coming down, which is encouraging. But you have a capex plan as well to satisfy. So could you tell us what was the capex you spent in quarter one? For the year, what is the outlook? And where does your net debt end the year at?
Net debt, if you see, last year we were able to bring down our net debt in spite of the challenging times that we were facing. In quarter one, further, net debt has gone down by 1,100 crores. By the end of this year, we will hope to get that overall number to the tune of 4,000 to 5,000 crores. Last year, we did 5,900 capex, which was ordinary capex, not really going towards expansion. This year, the number is increased to 7,500. However, the real capex towards capacity expansion will start coming from FY27. It is not expected in FY26. Not much expenditure will be there. So reducing our debt further by 5,000 crores is the target in this year. And from next year onwards, we will start seeing debt will increase because our capex on the ground for the expansion programs will start hitting us.
And in terms of capacity, what does it mean? Where are you headed?
going from 20 million ton today to 35 million ton by the end of the decade, that is by 2030. So overall, next 5 years, we'll be increasing our capex numbers.
And this will be at a capex of nearly around 1 lakh crore?
Approximately, yes.
All right, that's a tall ask. Then, if that is the case, this 20 to 30 million tons, sir, you can do it by a couple of other measures, right? You have a couple of PSU units. Maybe they get folded into it, which will get you closer to the target. NMDC steel is there. RINL is there. I can see you have something up your sleeve, sir. Is that a possibility?
These companies are by the government, so the government has to take a call. As a company, we are always happy to take up more responsibility and improve volume. We believe in the steel industry. Mergers and acquisitions are a big part of steel industry's expanding. And we, if given an opportunity, will be willing and happy to do that.
Okay, interesting. But have the government hinted there could possibly be a merger between all these assets, SAIL, NMDC Steel and RINL?
You hear as much as I hear, so difficult for me to comment on that.
Well, sales numbers fairly disappointing, but the management guiding for better terms ahead. They're saying for the year, volume growth will be 8%, margins will improve by 200 basis points in the coming quarter, and post that another 200 basis points improvement, and net debt will reduce by around 5,000 crores because the capex for expansion starts only from the next year. Stock ended down 4% yesterday. We take that small break, come back. Amnish Agarwal of PL Capital will be joining in for some fundamental stock talk. Welcome back. Hope you're having a good morning. Well, let's get into some fundamental analysis on quite a few stocks that are going to be in focus today. Amnish Agarwal, the Director of Institutional Research at PL Capital, joins us on the show. Hi, Amnish. Thanks a lot for joining in. Tell us, what do you think of IndusInd Bank's numbers? There's an equally bearish and bullish argument. One side of the story is that there's plenty of bad news ahead, where the other part says, well, we've already digested the bad news and now on a price to book valuation, but it's quite attractive. Which camp are you in?
IndusInd, I would say, is a difficult one because there are quite a bit of variation which comes in numbers. Sometimes in terms of this time around, I think the fee number has gone down drastically. Sometimes your GNPA goes up. Okay, so the numbers, these are like, you can say, topsy-turvy from the last. So
Amnish, you would say it's a buy, sell, or just an avoid for now?
It's better to be on the sidelines for the moment because till the time new management comes in and there is absolute clarity. So there could be wide fluctuations which can continue in this stock. And so for the investors, it could be a very rocky ride in the near term.
Okay, all right. The other one I wanted to ask you about is Mazagon Dock. Those numbers looked weak. We had Zen Technologies over the weekend as well. Those numbers as well looked weak. Defense, there's a long runway, but the numbers are not really showing off in quarter one. Would you be a buyer on a dip?
You see, defense stocks, but we should not look at on a quarter-on-quarter basis because what happens is that, first of all, the execution in many of these companies, that is usually back-ended and it happens in the second half of the year. That is one. And secondly, it also depends on how the orders are progressing, how the execution has been in the previous quarter and in the current quarter. So these stocks need to be looked at with I would say, at least 2 to 3 year kind of a viewpoint. And on a quarter-on-quarter basis, I think I would avoid looking at these names. And I think on dips, some of these stocks, I think they continue to make sense to be looked at. But in the near term, one should not expect any fireworks from these stocks.
Would you say the same for Kotak Mahindra Bank? Amnish, I'm Morning Surbi here. I mean, would you give them the benefit of doubt? It was just one bad quarter. How did you view it?
You see, Kotak and IndusInd are on a very different plane because in IndusInd, for example, the management change will be there. There have been a lot more problems, whereas the Kotak is actually having the growth issues not now from quite some time because the Kotak actually lacks consistency in terms of, say, numbers. A couple of quarters you will see they're good numbers, and then for 1 or 2 quarters the numbers won't be, I would say, that great. But definitely, if you run through all the banks, excluding say an HDFC and ICICI, there seems to be some stress which is building up on the MSME side, on the unsecured side, and that is sooner or later reflected in the numbers of all the banks. So I think maybe another quarter or so, the numbers will start improving. But as of now, I would say the Kotak one should not club with IndusInd Bank, but definitely ICICI and HDFC are the pick of the lot.
No, actually, I was asking more from the point of view, you said that don't look at defense stocks on a quarter-to-quarter basis, have a longer-term view. So that's why I was asking whether you will apply the same to a Kotak Mahindra Bank. That,
You see, the banks and defense we should not compare, because defense companies, for example, they might be sitting on an order book of 3 to 4 years, whereas in case of financial, it's a very different ball game.
Yeah.
So I will not apply that yardstick, but yes, it's a good bank. The capital adequacy ratios are there. I would say it's a strong bank, but slightly inconsistent in terms of, say, the performance. So on dips, yes, Kotak Mahindra can be looked at from the longer term.
Okay, all right, but go with caution. That's the advice that Amnish is giving out this morning. We'll take a break. Amnish, stay on. We'll have more questions for you. Quick break. Back on the other side. We'll also discuss market technicals with Sudarshan Sukhani and Mitesh Thakkar. Welcome back. So we're dealing with cues which are not very, very supported this morning. And the implied open has been telling us that we'll start lower, at least 50 points lower. Let's pull it up once again. We'll start getting our pre-opening rates as well. Yeah, still 40 to 50 points down. So what's the trading call for today and the setup? We have both Sudarshan and Mitesh joining in. Gentlemen, good morning. No respite for the bulls whatsoever. So let's start with the indices first. Mitesh, I know both of you have been sort of cautioning our investors and our viewers against taking any kind of big index positions. But anyway, for the day, Nifty, Bank Nifty, Mitesh, what would your advice be?
My belief is that, we've been kind of slowly getting downwards, slipping downwards. And, we've kind of, in the last 3 days, a bit of accelerated. But if you look at the charts in May, June, we had an important consolidation around this 24,500 mark, and that was the lower end of the consolidation. And then we have this big gap around 24,400 to about 24,300 zones. So I think another 100, 200 points down the line, one, the decline could be arrested. Two, then we should look for some reversal pattern. This is also helped by the fact that the put call ratio is now getting close to levels from where historically we have seen a rebound in the market. So maybe, a bit more of pain is left, maybe a day or two, some volatility, some choppiness could happen. But below 24,500, if we get there, then I would look at signs of reversals.
Absolutely. So that's the sort of next sort of support zone that we put out as well. Gentlemen, morning. Sudarshan, what about you?
Yeah, good morning. Well, I've been suggesting 24,500 as a possible support level when the Nifty was much higher, and that's very close by. So that's not a worry. Most traders know that we are drifting towards that support. The worry is something else. The worry is what happens if that support does not hold. There is no guarantee that any support level will hold and then give us a buying opportunity. That is my worry now, given the fact that Asian markets are in some kind of a significant downtrend. And America is not responding anymore to good news. Traders should not rush into buying if we reach 24,500. Wait patiently for a couple of days and see whether this level holds or not. If it does, then cautious buying can begin. So today, there is a trade only, sell on rallies or do nothing.
Okay, so sell on rallies and be very, very cautious before initiating any kind of longs. Got that point, gentlemen. Let's come down to stocks as well. Sudarshan, what's your stock list looking like?
Well, it's a mix. Dabur is a buy with a stop under 512. Cipla is a buying opportunity. Pharma, as you know, Pharma does its own thing while the whole market does something else. Cipla is a buying opportunity with a stop under 1539. I have two intraday shorts. One I am not able to pronounce properly, UNO Minda, which is an intraday short with a stop above 1,087. And the second is a warning This is an intraday short. Blue chips should never be shorted for more than a few hours. Bharti Airtel suggests some minor distribution. Consider going short with a stop above 1927, but cover up as soon as possible.
Okay, Mitesh, what about you? What are your trades?
Yeah. I have a mix of buys and sell calls as well. On the buying side is ICICI Bank. After the numbers also, we were having some buy calls over there. The stock did well, has held on and made fresh highs in a falling market. Now it can be bought with a stop below 1470 for targets of 1520. Dabur gave some kind of a reversal on the intraday hourly and 2-hourly charts. So buy here with a stop at 516 for targets of 535. On the selling side is Manappuram with a stop at 264, 264.5. And here I would look for targets of around 248. And Angel One on a bounce back, I would want to sell. Let's around 2630 odd zones. Keep a stop at 2680 and look for targets of 2525.
Okay, all right, got it. Thanks very much for that, Sudarshan and Mitesh. We'll come back to you a little closer to market opening. Take a break right now. We'll be back. We will have the pre-opening rates with us and also the promised conversation on real estate. Vijay Agrawal of Aquarius is joining in to talk about the prospects for listed real estate companies in the near future. Welcome back. We are getting some interesting rates in the pre-open. I'm talking about stocks. The index obviously is all over the place right now. PNC Infratech has announced a large order. I think it's from Eastern Coalfields. The value of that order is over 2,000 crores. And you'll see it flashing on the ticker as well. We've been putting that out. That's why that stock in pre-open is up almost 6%. And you have some sharp earnings reactions as well. Paradeep Phosphates, where the margins have literally, jumped year on year. Good set of numbers. Paradeep Phosphates is up 12% right now. But on the flip side, look at a Mazagon Dock. Disappointment from companies and stocks, with a big rally. Mazagon in pre-open, very early in pre-open, but it's suggesting it's 10% on the lower side. So that's how you're getting some pretty, clear, diverse reactions on earnings. Amnish, leave us with the stock. Anything which you really liked. We don't have too many great earnings this season so far, but your top pick, something that you're convinced about looking at the numbers?
You see, very difficult to give you, say, a single stock. As I said, for example, something like an ICICI Bank looks safe at this juncture. Or if I take, say, a 6 months view, ITC might be a stock which can give you, say, 15-20% returns also. But I think in the middle of the result season with not many numbers giving you a lot of comfort, I think it is very hard to pinpoint at this point of time. And maybe next few days will give you a better picture.
Sure. Okay. All right, Amnish. Thanks very much for that. Well, let's move on now to our promised conversation on real estate. It's been a good run for real estate companies for the last several months, several quarters. However, the question that's coming up now is that with this IT sector slowdown, is there a second-order effect, perhaps, that real estate stocks and investors need to be prepared for? Let's discuss this with Vijay Agrawal, Managing Director, Head of Infrastructure and Real Estate at Aquarius. Vijay, thank you very much for joining in. And that's the real question, right? These IT companies have been talking about low growth, slow growth, or no growth for a while. But now it seems they're talking job cuts. So now I don't know if you have a rough number to this. The segment that could be impacted maybe is the segment, which is 1 to 2 CR housing. On the listed universe, I don't know who has that kind of inventory, the maximum exposure. But are you expecting any ripples in the real estate market?
Surabhi, thanks. I think any news in the market always have a ripple effect. But if you see today, 40% of sales in Bangalore market are driven by IT employees. So definitely we may see an impact there from that perspective. But across the board, if you see general sales by the listed companies are about 2 crores. And yes, if there is a job loss, it will have an impact. Otherwise, impact will be minimal. But always market will be cautious from their approach and seeing the things, how it will pan out going forward in other companies. But if you see otherwise, the GCCs are increasing their headcount. So if any job cuts by TCS or other similar companies may be absorbed by the GCCs. So maybe we have to wait and watch for next 2 to 3 quarters how things are panning out and take a call on that basis.
Vijay, so from morning, let's talk about who has maximum exposure, if you can kind of put it that way, to GCCs. GCCs are where? Hyderabad, right?
Hyderabad and Bangalore.
Hyderabad
These
and
are
Bangalore.
the two.
But Hyderabad predominantly, and now some in Bangalore as well.
No, both the places. If I am not wrong, 50-50, you can say GCCs. See, Hyderabad has become an attractive market for GCC from the rental perspective and a housing cost perspective. So see, whenever a GCC is making a decision, they look from the cost of rentals as well as a housing cost for their employees. So that way, till 2 years back, Hyderabad was much better. Now, also, Hyderabad is still cheaper than Bangalore. So, and any GCCs don't want to rely on only one city. They would like to be a multi-city from the risk perspective. So, if you're opening a second center, you would like to open between Bangalore, and Hyderabad. So that's
and
the
number of GCC jobs, Vijay, are offsetting. I mean, of course, it'll take a long time. You just have to look at IT services. But I think that's a very macro, perhaps, way to look at it. Real estate is a very micro market, right? Yeah. Each city is different in that sense. So, in your coverage universe, where do you still find, fairly long runway for growth, even if pricing does not go up very much from here on, but volume-wise, things look pretty healthy? Which of those companies?
So, see, I think if you look at the listed universe, Loda, DLF, Oberoi, Prestige, these people have really reported much better numbers and a pre-sales number. So, and looks like if your new launches pipelines are good and you are continuing the launches, then your pre-sale number will improve and it will be there. And so that's the thing. Only I think the Q1, some markets had an impact because of we had a Operation Sindoor, Iran, Israel war, and this thing. So people, all the buyers sit on fence in such type of uncertainties.
No, absolutely. And that's something that Lodha cited yesterday in our conversation. And I mean, that's what they've been saying in their calls as well, that there was this Operation Sindoor impact. But I have two quick questions, Vijay. First of all, simple question. Do you think that demand from GCCs will fully offset the weakness in demand that we may get from the IT sector for key markets like Bangalore and Hyderabad and Pune?
Yeah. So I think looks like GCCs will offset the demand for any losses from the IT retrenchment.
Okay.
Because if you see the space absorbed by the GCC is much higher. I don't have often the numbers, but generally if you see 20 to 30% of the leasings are absorbed by GCC. If that's a number, that means the GCC headcounts are increasing.
Talking about residential, Vijay. Residential is what we're discussing, because obviously if there are job losses on one side, but then GCs are employing, and they're employing with decent salaries as well. So I was saying residential demand weakness because of weak demand from IT service employees, will that be fully offset by GCCs?
Yes, that's what I'm saying.
Okay, got that. My second question is that would you have a rough sense of, say, if we talk about that bracket of 1 to 2 CR, which are the listed developers which have maximum exposure to this segment? Because a lot of companies like DLF anyway, I mean, the bulk of their sales are in much higher ticket segments, or even in Oberoi for that matter. Who is biggest in the 1 to 2 CR bracket?
I think people who are focused on Bangalore, Chennai, and Hyderabad market will have a focus. So I would say Prestige will have that share. But yes, Prestige, Brigade, and like the other play, Shobha, they will have a larger share of 1 to 2 crores sales in their portfolio.
Okay. Yeah, no, absolutely. We've kind of asked all these companies.
Because the bomb.
Yeah. Yeah. No, I mean, IT firm hirings have been going down for the last many years. It used to be in the tens of thousands, but I think last couple of years it's come down to a trickle. And we've asked that question to companies like Prestige. Vijay, you mentioned Prestige, whether IT hiring slowdown is going to affect your sales. And the answer we've consistently got is there is no sort of, I mean, there is enough demand. I mean, it's not just IT services. Other segments are doing well. The traditional IT services, which is TCS, Wipro, Infosys, etc., maybe they're hiring less, but it's getting made up by from other sources. Startups, for example, is one big segment, and so on and so forth. Thank you very much, Vijay. Good to have you with us here. Appreciate your time here on CNBC-TV18. I think we just, at the end of the pre-open session, maybe just take a quick look at what's happening there. And then we'll move on. 70 points lower, 24,600 is where the Nifty is now at this point in time. Sudarshan and Mitesh are with us with what they want you to do. 9-10 call. Sudarshan, back to you. What do you have?
Well, it's Cipla. Consider buying Cipla with a stop under 1539.
Mitesh, what about you?
Sell on Manappuram for targets of around 248.
Okay, Cipla and Manappuram. Got that. Let's welcome in, okay, thanks very much, both of you. More later at 10 o'clock. IndusInd Bank is we want to focus on once again. Reported numbers. Gaurav is here with what you need to know and what's the street made of the numbers. Gaurav, take it away.
Well, yes, IndusInd Bank, street was expecting weak set of number, and bank has delivered fairly inline numbers with what the street was expecting. Net interest income declined almost by 14%. When it comes to net interest margins, there was a surprise because it came at around 3.46 versus the expectation of 3.2%. But on the other hand, now operating profit that declined almost by 35%, and one negative factor here is that the fee income that actually declined, and as a result, we saw some pressure in the operating profit. Other than that, credit cost, as we expected, it remained elevated, although it has declined on a sequential basis because last quarter's base was high. But again, that is something which is concerning, and as a result, profit declined almost by 72% on a year-on-year basis. Now, what is a key concern here is that limited triggers is what the market is seeing in IndusInd Bank going ahead. If you look at net interest margins, there is going to be some kind of pressure. When it comes to operating expenses, now management has said that it will grow likely in a single digit, so there may be some less stress there. But other than that, credit cost is also likely to remain high, and as a result, now Street is concerned about the ROA delivery. In fact, we've got a few brokerages. JP Morgan, they believe that the operating profit is likely to stay subdued in the next 3 years, and they also believe that there will be some pressure in ROAs. When it comes to Macquarie, they believe that ROA is likely to remain below 1% in the near term. And we also have Bernstein, who believes that this set of result actually forces reassessment of near-term ROAs. So definitely, there is some concern raising about the ROAs if it will reach 1% even in FY27. And as a result, we are seeing some pessimistic view from brokerages, and also on the back of that, we will be watching out on this stock today.
Okay. All right, got it. Thanks very much for that, Gaurav. Let's quickly head to Ekta, revisit numbers that were put up by Torrent Pharma. Ekta?
Well, yes, largely an inline set of numbers for Torrent Pharma this quarter. So the revenue was up around 11% on a year-on-year basis. The EBITDA also was largely in line with estimates in terms of the margins. It came in at around 31.4%. The street was anticipating around 33%, and the profit at around 546 odd crores. What they did record was growth in all three of their key geographies. So India was up around 11 odd percent year on year. US was up around 16% to $36 million, and Brazil was up around 11 odd percent. So there was double-digit growth in three of their key geographies, and that's the reason why there was optimism around the Torrent Pharma numbers, largely in line.
Okay, all right. Thanks a lot for that, Ekta. Well, let's go back to Mitesh for a quick comment. Mitesh, any view on Torrent Pharma?
Well, see, Torrent Pharma in the last few weeks, has done very well. But I actually don't have a very clear understanding of what the future movement will be. My sense is that if you get a decline, some pullback, then it will be a good entry point. Otherwise, at this point in time, it's run away so fast that the risk-reward equation for an entry is not good.
Okay, got that. By the way, just put up Premier Energy as well. We'll just take a look at what the stock is doing. Any thoughts on this one? If you've tracked it on charts, 1,050.
Yeah. I do track it, Prashant. If you look at the last few weeks, the stock has been in a range of about 1130 to roughly about 1,000. I think the way the charts are shaping up, it will still be range between these two levels. Only a move above 1110, 1120, could suggest that we are preparing for a breakout. For the time being, doesn't look like. I'll assume that it will be, within this range.
Okay, I think we're just hitting market open and we'll take it from there. Mitesh, thanks very much for that. 70 points lower on the Nifty, 270 lower on the sensex. Just waiting for the first rates to start to appear up on our screens. IndusInd and Premier and KEC are, of course, some of the earnings-related reactions which we will watch out for. But there is other stuff as well. So what do we have? First rates coming up. We've been in a bit of a down drift. And will some of these supports that we put out hold is the question. 24,600 is on the Nifty, 24,620 or so. The Nifty Bank is starting about 0.25% down, 55,900 and actually 56,000. So kind of around that round number. Small cap index is down 0.25%, 18,023. And I think you've got the mid cap index, which will come up about 100 points lower, 57,450 is where we are at. Advanced decline is negative, 950 stocks are lower and about 670 stocks are higher as things stand. So this is a bit of a lower start. Nifty heat map will give you a sense of how we are starting. Actually, it's a pretty quiet start. Maybe single stocks, broader market in a bit. But BEL is down and Adani Ports is on the other side. So more down than up, certainly 30-odd names down and about 20 names which are starting in the green. Surabhi.
Absolutely. It's very, very soft. No clear trends. IT is still seeing some pressure. Infosys is down 1%. Wipro is down 1%. There's some more red on TCS, but I think Infosys is bucking the trend. No, actually, Infosys is also down now 1%. So most of IT is seeing some follow-through selling. Eternal is seeing some profit taking after its stupendous run last week. Eternal is down 1% this morning. Shriram Finance also seeing some profit taking. It was yesterday's big winner. The banks are not offering too much support. HDFC Bank and ICICI Bank both are subdued, losing about 0.5% each. Titan on the lower side. So, yeah, it's a little all over the place. On the upside, there's some sense of buying in consumer stocks, some perhaps defensive buying. So, Tata Consumer, Nestle, Lever. These are the stocks that are gaining a little bit. And some metals like JSW Steel are managing, again, 1% up on JSW Steel. Coal India is managing 0.5% as well. But that's about it. Reliance, for the time being, absolutely at the flat line. Very quiet. Hardly any movement on the Nifty.
Well, in this sort of a weakish market, a subdued market, you still have some big winners. Paradeep Phosphates, take a look at that stock. Bucking the trend, that's up 12%. So the market is clearly distinguishing between numbers that they like and numbers that are very subdued. The stock from the mid-cap space is up more than 10% as we speak. Big up move is what we're seeing. Vare Energies as well, one would argue that, the global environment is going to be very, very subdued and maybe, in fact, it has a limited number of years ahead of it in terms of good amount of demand. But some on the street believe, well, no, the runway is still massive. And that stock, in fact, I remember towards I think around 6 months or so ago, it went to around 2,100. From there, that one has given you 50%. And these numbers look good. They're reiterating their guidance out there. Another stock that's reacting positively is Acme Solar. We'll try to get the management, I think, in the next hour or so at around 10:30 a.m. on Chartbusters. That's reacting positively as well. NTPC Green Energy, that's the other one that's reacting positively. So all these stocks actually are reacting fairly favorably in today's trading session. Premier Energies, let's pull that one up as well. All these stocks, remember, came out with a set of numbers and they are reacting positively. On the flip side, the weak result reactions. You have Aeroflex Industries, that's down 7%, seeing a lot of profit taking out there. Torrent Pharma, that as well is getting slammed. So that's down, in fact, close to around 3%. However, from the frontline index, I think IndusInd Bank, after starting off in the red, has done a complete U-turn. That's moved well into the green. And Marsgaon Dock as well, that was at lower circuit for some time in pre-open on low volumes. That's done a big turnaround as well. Now it's down only 3.5%.
Just one more stock adding Nigel to your list is 5-Star Business Finance. It's down 10.5%. Asset quality is stress and the market doesn't like it. So that's probably the earnings casualty this morning.
Okay, absolutely flat change on the Nifty, 24,680. And by the way, the markets turned into the green, even as we had a largely negative start. We are back up again at this point in time. Just taking a look at what else is happening. Okay, we'll just put up more specific names in a bit. But while we do that, let's also bring in Rana Gupta, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, great to have you with us here on the program. Thanks very much for your time. Let me actually take the conversation in a slightly, I mean, you have a global perspective as well, and you of course invest here in India. Are you, and I've been sort of reading at the margin about this, that in China, across a range of industries, right, there is a push now to cut supplies, cut output. Basically lessen competition because, I mean, there's a glut of supply and there's basically deflation, right? Producer price numbers in China have been negative for a while now. Do you think there are any implications of that in specific industries here in India? I mean, chemicals, for example, comes to mind, Rana. What else? I just wanted your sort of starting thoughts there.
Good morning. No, that's an important aspect, and we should talk about it. There are two aspects to it. One broadly macro. After a long while, we see something macro coming out of China. This drive is called in English anti-involution drive, which basically means to cut supply. And we have seen this something like this 2016. Now, if you think about solar cells, steel, metals, electric vehicle, all this, China has huge overcapacity. And the overcapacity comes from the state-owned enterprises. So we do think some consolidation will take place there. Profits can improve at the margin, and global demand supply scenario at the margin can get better. At the first level, I think this makes overly sold and pretty cheap Chinese equities at the margin attractive. And we have seen some money flow into the China share markets, and I think that isn't quite well. On an implication to India, at a flow level, I think this makes China more attractive. But coming to fundamentally, as far as the metal part is concerned, I think that can be benefited positively if the supply cuts really come through. However, I think in the solar and electric vehicle, the overcapacity is pretty massive, and there's not much inflow from China to India. So there, I think the impacts are more global in nature. Lastly, in China, e-commerce also, there is a lot of competition, and that's mostly in the private sector. So I think much of supply consolidation may not happen, but there's just a read across. There's been nothing too much read through for Indian equities as such in that aspect.
So metals primarily, Rana?
Yes, that's correct.
And chemicals as well? No.
Chemicals, I think one has to, because chemicals is such a broad area, one has to be very specific. Certain chemicals will do well, but I think the issue is that chemicals, there is a lot of oversupply also. So chemicals really have to go bottom up, part by part, and see which chemicals benefit. Certain chemicals will benefit, but even in Indian chemical space, if you look at the larger companies, they are, there are companies who make a lot of it. So at a company level, we are unable to identify that which company will really stand out and benefit. That said, I think at balance, you're right. I think chemical, there are some benefits in certain segments.
Okay, got that point. Rana, hi, morning. So we all know that in India, right now, we're dealing with a bit of an earnings issue. So in this environment where the market's sluggish, earnings are not really picking up quickly enough, just take us through your portfolio construct. Is it more defensive in nature? I mean, what are the changes that you've made over the last couple of weeks, if at all? What are you, where are you parking the cash, and what are you avoiding?
I think a best way to look at this will be, let's say, the last time I was in a channel, I mentioned a pretty positive view on the consumer, on the financials, as well as the infrastructure. So let's see how those have panned out. I think the consumer stocks, particularly in the food tech segment, particularly in some of the select retail stocks, has seen a significant rally. So as in the financial side, particularly the mid-cap banks and the non-banks, which are very levered to rate cuts. Now, these stocks had a good run-up, and the results have not kept up pace. Now, it has to be said, even on a standalone basis, results are a tad disappointing, even adjusting for the Q1 sluggishness that happens. So I think from here on, it's going to be a bit of a patience will be required, because the fundamentals will take some time to turn around. When the asset quality has worsened across the board, I think it will take about 1-2 quarters to stabilize and then come back. Because the stock price had run a bit ahead over last 3-4 months since the time the rate cut and the tax cut happened, I think a period of adjustment, we look at this quarter will be a period of adjustment for consumer as well as the financial stocks. The infrastructure side, we continue to be bullish. I think infrastructure side, particularly real estate and power, will continue to see good demand. I'm referring to top-end real estate and the renewable power plant here. And at the margin, because globally, I think the anxieties regarding trade, anxiety regarding China's oversupply, at the margin is diminishing a bit. That makes some of the global cyclicals that one has avoided, whether it's IT or metals, at the balance or even tactically, tactically a bit attractive than they were beginning of this year.
Hi, Rana. Good to see you in. Tech, I just want to clear that point on tech. TCS went ahead and they said they're going to be pulling back closer on 2% of the global workforce, not because of AI, but because of a talent mismatch. Yesterday, to be fair, actually the stock didn't react very, very negatively. So that wasn't the reason to sell the stock. But do you think with a lot of this negative news that's coming in there, the IT stocks and the IT sector slowly on that process of actually bottoming out and then it becomes an investable idea? Or do you say there's too much of uncertainty, you'd rather stay away?
Look, I think on IT sector, the AI is going to be a structural headwind. That is not to say that from time to time we will not get tactical investment opportunities. Now, what TCS has done, basically, I think this skill mismatch. I think it has a lot to do with AI, and the way AI is increasing productivity of people. So many people record or not, that's a matter. I think we will continue debating for the next 1 or 2 years, and you will see more on this front. But the broader point is that the IT stocks the index is down about 15-16% this year, market up about 5%. So they have underperformed 20%. There is bad commentary, and also their clients, they have not closed deals as evident in commentaries of most of the IT companies. But now with trade deals getting signed and US tax cut coming through and all of those things, we do expect a bit of pick up in the deal momentum. All the pricing pressure will remain. I think that is, we have to just accept that fact. And because the valuations have corrected, they look a bit reasonable. There is room for a tactical trade in IT in our view.
Tactical trade in IT. All right. And from the pack, what would you prefer? The ER&D, the large cap names or the mid cap names?
I think because the large cap names and as I said, they remain tactical trades. But I think if someone were to look at somewhat more durable investment ideas, one has to look at companies which are not really mid cap companies, because these companies also by now grown, but where either the management is pretty aggressive in deal wins and going ahead with these deal wins. If you can go through earnings transcript, you will see there are 1 or 2 companies who have got very decent deal wins, even if this macro environment. So I think that is one bucket one should be, relatively speaking, bullish on. The second is the companies where they can do a lot with AI, because I think this AI is one theme which is only going to grow bigger and stronger going forward. There are 1 or 2 companies in Indian IT space where they facilitate AI and agentic implementation with their clients. And I think, and that accounts for a pretty chunky part of the business. I think those are the businesses on a bottom-up basis also we like. But top-down large ITs, I think large cap ITs, they are so big, they will take time to adjust to these realities. And this kind of job cut news that you have heard, I think this is not the end of it. There will be many more adjustments required. But that said, not stock picking is different. There could be room for a tactical trade after prolonged underperformance that IT companies have seen.
Okay. All right. So that's the sense on IT. Rana, what about infrastructure and industrials? I mean, again, here we'll be speaking to one company from that space, KC International, in just the next couple of minutes. After being among the big leaders of the rally back in end 23, early 24, how are you positioned on these stocks? Because at least from a valuation perspective, some of the multiples have cooled off now.
So the infrastructure industrial side, what we like is somewhat, I would have to say, the rare in that industry, that visibility of cash flows. The construction companies, they hardly generate significant cash. And I'm talking about just operating cash flows. And that need not be like today. But we need to see visibility of cash few years down the line, because in our view, the cash should be reinvested for growth and not too much of debt and external funding and liquidation and capital raising perhaps not the best way in our view. With that construct, we prefer the asset owners, and the asset owners, particularly in the renewable power segment. That is one area that we like. On a broader sense, at least here in regionally, we also consider other asset owners as infrastructure plays, and this will be something like a telecom, hospitals. They're also even airports. They're also infrastructure plays. So asset owners, steady cash flows, growing cash flows. Those are the kind of businesses that we like.
All right. Interesting. Yep. Interesting perspective on what sort of you can consider as infrastructure. And you're looking at some of those other related allied sectors as well. Got that point. Rana, thanks very much for joining in. Good conversation as always. Wish you a good rest of the day. Well, the market has stabilized. For what it's worth, I mean, considering weak global cues this morning, there is a bit of a bounce. We've been saying that we've been at the lower end of the range, oversold levels, whether you're looking at the F&O market cues, etc. So maybe from those levels, at least there's a bounce. Let's see. Bulls will hope this really holds on. Let's focus on KEC International now. The company reported a steady set of numbers for the first quarter. Profit growth was healthy. The order inflow is something that analysts are watching very, very carefully. Of course, KEC has given a guidance of 15% revenue growth this year. Let's talk more about the outlook and what's happening on ground. We have Mr. Vimal Kejriwal, Managing Director and CEO of the company, joining in. Mr. Kejriwal, good morning. Great to have you back on. Always good to hear from you. So, sir, let's start with the order inflow guideline. I mean, otherwise your pipeline is very strong. I think your order book plus L1, you're at 40,000 crores. So that's a solid number. But I think analysts are looking at the granular details of how many orders you'll get this year. I think the intake was about 5,500 crores last year. Is there any concern of a slowdown, particularly in the West Asia markets, because oil prices are weak? Is there any decline or softness in tendering activity there? Is that a risk?
So let me give you the correct figures. Actually, we got 5,500 crores of orders this year, which is almost 28% lower than last year. But we are L1 in almost more than 6,000 crores, and largely in the T&D area. And surprisingly, most of them are in West Asia. So I don't think we are seeing any slowdown. I'll say any slowdown in that part of the world, whether it is Saudi, whether it is Oman, whether it is UAE. They are just continuing to, keep on releasing tenders. In fact, right now we have almost 25,000 crores of tenders to be quoted in Saudi itself. Okay. So I don't think people have to worry about whether West Asia will do well or not. I think we are very positive about it. I think what we need to also understand is most of these orders are on the back of renewables which are being set up. So most of them are for the transmission of power from renewable sector. So I don't see any risk right now from the oil prices in this market.
Okay. All right. That would be very reassuring for all your stakeholders to hear that the West Asia market is still booming and looking good with renewables specifically. You said 6,500 crores. Those are the orders for which you're L1.
Not 6,500, but yeah, I don't know the exact, but it's 6,000 plus. And I think almost 90 to 95% are in the T&D sector. And I think close to 4,500 or so are or maybe more than that, are in the T&D part of it.
In that. Okay. So you're sounding still very, very optimistic, at least on the T&D pipeline. Water will come to later. But just, hearing you out, you're confident of delivering 15% growth this year, top line?
100%. We are very clear.
Okay.
All right.
Kejriwal, 15% is top line growth as you see it. Should not be a problem. Good morning, sir. Just to complete that earlier point, where you said that most of the orders are renewable, and that is something we've heard from other companies as well, right? I mean, because the grid does not exist and it has to be built. If you've got to set up all these renewable projects and you've got to get the power from where it is being produced, generated to where it is needed. Is there a slightly longer kind of runway, some numbers you can share with us, because you are speaking with customers, you know what's happening there, especially in West Asia, Saudi, etc. Is it going to be a very large business over the next a few years?
Yeah, morning, Prashant. I think you're very right. There will be a very long business. I can see very clearly Saudi has just announced some more new tenders for renewables. Abu Dhabi is going. Oman is doing very well. I think all of them are very clear that they want to reduce their dependence on oil for power, and they want to use oil for other purposes, etc. So very clearly we can see in West Asia, India, you are very clearly aware that from 500 gigawatt now the government has upped the target to 600 gigawatt in 2032. So I personally do not see any risk happening on that part of it. The other piece is that all these renewable projects come at a place where you have ample land available, which is generally far away from the consumption center. So they require large transmission lines. So which is where I think we are very positive on those markets.
Can we estimate some sort of I know it's an unfair question, but a TAM, a total size of opportunity here, just based off this renewables, etc. being set up?
I don't think I have that number right now, to be very honest with you. But if you look at the T&D orders to be tenders to be bid or which are under bidding and not been decided, is around 90,000 crores as of now. Okay, that's the size, and that's for next 3 months sort of thing. So there's a huge opportunity which we can see in this market.
So it's. I mean, you got to pick and choose the work you want to do. I mean, there is enough demand.
I'll say almost.
All right, hi Mr. Kejriwal, good to see you in. And as you're indicating, in the past quarter as well, we did see TNT projects, higher margin projects got executed, which helped margins perk up a little bit. But you have guided that margins will improve from here on. So the top line growth, we've got 15%. Margins, you continue to hold on to that 8.5% guidance. No risk there?
No risk for that. 8 to 8.5 is what we have been guiding. First quarter, we did 7%. So I think we are on track for that.
All right. So the margin trajectory continues to improve from here on. Give us a sense, even in terms of your debt reduction. You were told us last time around, I think as a percentage of sales, it was around 3%. That's likely to come down. It appears you have repaid some debt. So what is the updated debt number, and will this continue for the remaining of this year in terms of debt reduction? The absolute number is what I'm asking. And working capital days, you were guiding that it comes down to around 110 days by the end of this year. That as well holds on, right?
Yeah, that holds on. Although in Q1 we were slightly off.
120 plus.
128 instead of 122, what was there last year. But I think we are very clear on that target that we should be achieving that. Debt, we have been able to have a reduction of around 250 crores despite an increase in sales. So I think we are looking at that debt going down below 5,000 as an absolute number. And our interest to revenue has been 3%, come down from 3.4%. So we're trying to take it to around 2.5% is what we are looking for.
Mr. Kejriwal, now I'm coming to the water business, and you explained it really well to us last time around that it's an issue with payments being released by states. And then you have to be very careful and, take state-by-state calls. So what is happening with that business right now? Also, just give us, so we understand its relevance in terms of, say, your total order book. What percentage is water? Or maybe your total revenue pie. What percentage is water right now? And will you be getting, the 1,000 crores plus revenue, which you told us last time, that things are picking up, that it's beginning to move. What's happening here?
So let me come to the numbers first. So this quarter, I think we got, for Q1, we got around 257 or odd crores of cash flow from the business. Okay. And even now we have got some money. In fact, yesterday evening also we got some money from one of the states. So we are primarily in two states, MP and Orissa. MP has been relatively much better in terms of payment. Orissa is just opening up. I think they had some issues, so they were not making payment. But now the payments have started trickling in. I'll not say it started flowing in, but they started trickling in. The way we have been looking at it is that we are not planning to increase our exposure. So whatever cash we get from the business, that is plowed back into that business for completing of the projects. So I think when you look at the number, if I got 250 crores of cash in Q1, and if you multiply it by 4, I assume it will continue, then we should be reaching our 1,000 crores of revenue target for the year in water.
And what is water? What is it as a percentage of your order book? And will you now be, degrowing, as they say, degrowing or defocusing on this business?
I don't think we can defocus. It's a strategic business, and I think the government has to sort out the issues in the cash flow, because part of it gets funded by the central government, part of it gets funded by the state government. So I think there is some place where it's not working out very well. I think it's getting sorted out. As far as the order book is concerned, I think we have roughly around 2,000 crores of orders yet to be executed in my order book. So that's, if you take 40,000, then it's around 5% of my order book.
But it's a higher margin business, like you explained to us.
It's a double digit.
It's a double-digit margin business. So hopefully it gets sorted out. Got your point, sir.
Slightly forward-looking kind of this thing. This is war in Russia, Ukraine, right? Now we've heard from a lot of the transmission, distribution grids, etc., have been completely destroyed in that country. Is that whenever and President Trump is calling for a ceasefire in the next 10, 12 days. I mean, the war is going on for 3 years now. I mean, do these kind of things open up whenever there will be a big rebuild effort whenever it happens, whenever the fighting stops? Are those also opportunities in your as you see them?
100%. I think these are places where there are a lot of opportunities. And let me give an example. Already we started receiving inquiries from Syria. Okay.
Oh, wow.
Okay. So I'm just saying that, and Iraq is already rebuilding, although I am not there right now, but some of my competitors have already gone to Iraq where they have started rebuilding lines. Syria is probably one step behind that, and Ukraine is probably still a little bit behind that. But in Ukraine, I know we've been getting inquiries for supply of, transformers and towers, etc. Nobody will go right now to build a line there. But supplies and all inquiries are already being discussed. I received some of the inquiries. So I think maybe 6 months down the line or something, or maybe even earlier, you may start seeing something happening in that market. Okay.
No, that's very interesting. And those things, of course, I mean, very difficult to put a number to it, but those are potentially very large rebuild efforts, right? Typically billions of dollars over, of course, spread over many years. We'll continue to track it, but it's interesting you're saying you're already starting to see inquiries come through, even from Ukraine, etc. Thank you very much, sir. Thank you for joining us. It's always a pleasure having you here on CNBC-TV18. Markets are up about 8 points, but 8 points is not the headline. The headline, of course, is the bounce we've seen from the day's low, although we are within the first 1 hour time frame. So still, I mean, I think finding our feet for the day. Nigel.
All right, well, let's get to our next earnings conversation then. TTK Prestige reported actually a weak performance in Q1. Muted revenue growth, decline in margins and profits. To discuss this and the impact of the quarter gone by and how is business shaping up from here on, we're now joined by Mr. Venkatesh, the Managing Director and CEO at TTK Prestige. Hi, sir. Good morning, and thanks a lot for joining in. I'll tell you what, for your category and your company as well as the segment on the whole, the street is willing to look ahead. So the past quarter was a weak one, but that was anticipated. Tell us, how are things likely to shape up from here on? And before we get to numbers, are you seeing signs that Q2 is gradually shaping up to be better? There's a recovery in sight. You'll also, towards the end of September, it'll be pre-Diwali, so there could be some festive buying. So are there green shoots that you're seeing?
Good morning. Thanks. I would address this in two parts, one from a company perspective and two from the industry perspective. Our belief is that the industry is slowly back on track. Volume growth is still a little more tepid, but we do see two distinct trends. One, in the urban markets, we're seeing premiumization happening, a lot more of value growth happening in comparison to the volume growth. And two, in the bottom end of the spectrum, as we see some of the lower priced opportunities, there is volume growth happening. So combined, in our view, the industry looks a little tepid at this point of time, but our belief is that it will start picking up as it moves forward, driven by both premiumization and also volume growth at the mid and the bottom end, as we see it. From a company perspective, you're aware we've gone through a large-scale transition of leadership, and currently the management is in place, stable. And we do believe as we move forward, some of our efforts that we are putting in terms of market corrections, in terms of our go-to-market strategies, this would lead us to a reasonably good growth as we move forward.
Okay, all right. You were earlier guiding for high single-digit growth in this year. Do you think that's on? Is there a possibility you can deliver a double-digit growth? And also, if you could give us a sense in terms of margins, what is the band we should work with? Q1, obviously, you didn't get the benefit of operating leverage. But since you're talking about a recovery from here on, that will play out as well.
I don't want to give any guidance, but like I said, I think we're quite confident that we will move into reasonably good growth as we move forward. As far as margins are concerned, we are considerably investing in a little bit of futuristic investments across capability building across capacity expansions in specific categories like cookware. And we do see, therefore, there would be a substantial investment in both OPEX as well as CAPEX that would go over the next 2 to 3 years. So that would place our margins at a reasonable place. Suffice to say that I think we are in a phase where a little bit of additional investments when compared to the industry is happening, both in terms of capability as well as in terms of CAPEX.
For Mr. Vijayaraghavan, good morning. Any specifics you can share with us in terms of what your, how are you thinking about the cookware as a segment for FY26? Any key changes in product mix, etc.?
We've actually moved ahead. We've had some product portfolio gaps in the past, which have got sort of corrected today. Currently, as we speak, we do believe that cookware is one of the segments that will continue to grow reasonably ahead of the other categories that we are in. For two reasons, like I mentioned, there is a lot more replacement cycles have got shortened in the cookware segment, a lot more acceleration around volume. That combined with premiumization happening in the top markets, I think cookware is a little more better poised than appliances and cookers in terms of growth. And we would like to capitalize on this as we move forward, and which is one of the reasons I said the CAPEX expansion is happening at this point of time. Having said that, I think currently our NPDs as well as our product portfolio is reasonably ahead of the industry, and a lot more emphasis on the cast iron portfolio, the stainless steel tri-ply portfolio, a lot more emphasis on some of the new materials that we would like to experiment with. Ceramic, for example, is one of the materials that the industry is experimenting with. Globally, it's picking up, and I do believe that in India, that probably would be one material-specific idea that would probably pick up as we move forward.
Mr. Raghavan, so growth you're saying should gradually pick up. What about margins? Because we've seen a fair amount of compression on margins in the first quarter. The company's been guiding, saying that, there will be some readjustments on margins before things finally settle. So where are we in that curve?
So
is this a bottom, or is the bottom still further down?
So I would suggest that we are at the initial stages, like I mentioned. It's a 2-year to 3-year transition. I would say there would be a couple of quarters before we could probably sort of answer this in a very firm manner. I think the guidance from our side is that we stay invested, and the investment is of substantial quantum, like we mentioned. And therefore, I think for a couple of more quarters, we would see this happen where there would be a little bit of EBITDA dilution as we had predicted in the past.
So some sense of it, I mean, I think you're just above 6% now at the EBITDA level. I mean, how much lower could perhaps margins get, and where do you see the point of turnaround? You're saying 3 quarters down the line. By the time we exit FY26?
Yeah, towards this year, we should definitely see a turnaround.
Okay, all right. What about the mix for you between rural and urban? What is your sales mix?
So we are largely urban driven, while we have a distribution system which is fairly entrenched as a leader in the rural markets. Our belief is a lot of our growth today is coming from urban markets. Rural, in my mind, is still unexplored. We did have an indirect channel through the institutions that we used to sort of sell in the rural markets. Now, that channel has been under pressure for the last few quarters, given some structural changes that are happening there, the multi-finance institutional opportunities. So as we speak, I think we are largely urban driven at this point of time, with a large opportunity at the bottom end. Rural, I think, is something that we would believe would start kicking in for us a couple of quarters down the line.
Okay, all right. What about the export markets? Mr. Trump has something to say every day. But, going according to what you've heard, some Indian producers in various segments, they believe actually it's throwing up an opportunity to push through exports. That's still very small for you. But is there an opportunity, in the horizon, say, 4 to 8 quarters down the line, you can actually see a big opportunity emerging?
So I think there are two trends as far as exports are concerned. There is definitely a willingness from most of the global players, including European players. So I see it as two parts. We play largely in the OEM segment, as we call it, or the white label segment. We are not into branded products at this point of time. In the white label segment, if you were to look at, there's a lot of intent to shift to India. Of course, there is an ecosystem issue today in terms of costing that we need to work out when we compare it with, say, competitors like China. But I think there's an intent from a large part of the globe to shift supply chain towards India. And that's a very positive sign that I would say from a long-term perspective for white label exports in our categories as we speak. The second part of it, as far as the US market is concerned, I think the signals have been mixed. Our experience has been that a lot of players, including our partners in our branded space, they have sort of not been able to conclude as to what is the impact, and therefore there's been a little bit of holding back in this quarter. But if I were to take a slightly longer horizon of 2 to 3 quarters, I think it will play out, and it may play out to our benefit.
Okay, all right, Mr. Vijay Raghavan, good conversation, sir. Good luck. Thank you very much for joining us. And we'll keep a track on what's cooking at TTA Prestige as we go along. Thank you. We'll take a break here. We are coming back in just a bit. I mean, the big stock move of the day has been Tata Chemicals, right? I mean, it came out of nowhere, and that's at almost $1,000 now. It's coming through very, very sharply. I think there is an upgrade which has come through as well from Morgan Stanley, and we'll highlight that with our team as we go along.
Just one more stock, Jaiswal Nico. We were, last week we had explained here on CNBC-TV18, there were 25 crore shares with an ARC that was gradually being absorbed. In yesterday's disclosure, a very, very small 52 lakh shares has been bought by the promoter entity of Shyam Metallics. It's an extremely small investment that's come out there. But the bigger point is, from around 25 crores of holding by the ARC, that ARC's holding has now come to sub 5 crore, and currently the volumes are very, very large. So we'll have to keep an eye out on this one. But we've highlighted that this is an overhang. Till the ARC continues to hold stake, that will be an overhang. Once that gets absorbed, Jaiswal Nico is the company that we're talking about. The volumes are very high. That's why we're just highlighting this, purely for educational purpose. There was a filing on the
we should put up
exchange.
Let's put up the stock if we have it for a quick bit, and then Jaiswal Nico, right?
Yeah, that's the one.
We should have. Are we able to pull it up? We should. If okay, I think it'll come up.
No worries.
Now. On your screen now. So that's the one that Nigel is talking about. 12.5% higher, 46.5 rupees. So it's a big move which is coming through. We'll take a quick commercial break here. We're going to come back in just a bit from now. We'll have the management of Premier Energies join us to talk about their first quarter numbers. Stay tuned. Okay, welcome back. Let's talk about the renewable space, right? And we have a bunch of listed companies now, which allow you to give which give you a play on renewables directly, solar especially. And I have the management of Premier Energies with us now to talk to us about the numbers which they reported for the quarter. Vinay Rastogi is Chief Business Officer at the company. Vinay, great to have you with us here on the program as always. Good morning. I would like to talk about competition, which I think is the big bugbear, which investors are worried about, which we will get to in just a bit. But let's just address the numbers for a quick bit. So order book in the quarter, as I see right now, is kind of flattish, right? But you look at margins have come off. They were about 33% in the fourth quarter. They're about 30% in the first quarter. But these are still, compared to a year ago, they're still significantly higher. They're almost double. So quarter-on-quarter decline, but year-on-year, I mean, it's a big jump. Order book, though, is kind of flattish. So let's just address those, especially the profitability point, Mr. Rastogi. The decline that we saw on a quarter-on-quarter basis, what was it on account of? And could you guide the market for the full year, EBITDA margins? Mr. Rastogi, you'll have to unmute yourself, sir.
Hi, can you hear me?
Yes, please go on.
Hi. So I'll start with the order book. I think our order book has still grown over the last quarter. And what has happened during this quarter is that there was a lot of volatility in the international prices, particularly in relation to some of the raw materials. So as a result of that, both the customers as well as we as a company, we felt that it was a better time. It was a time to kind of let the market settle down a little bit and then move towards order execution. So as it happens, since the end of the quarter, we've already signed some large orders, and our order book is actually very, very healthy. So I won't read too much into the quarter ending number as a result of that. In terms of margins, so again, our core profit margin remains intact. Our profit numbers are actually at all-time high. What you see in terms of the slight depression in the EBITDA margin, That's merely an accounting entry. Because, as I said, the international raw material prices were volatile, as a result of which, as a conservative policy, we have taken a markdown on one of our raw material inventory. And that has pushed up the cost of goods sold, causing the slight dip in profits. But as we go forward, as those raw materials get converted into finished goods, we will see those accounting entries being written off and the profits come back to normal levels.
Mr. Rastogi, could you give us an end of the year number for both? Where would order book be at?
So,
and where would margins be at?
So, what I would say is that the Indian solar market is growing exceptionally well. We had a best ever quarter, Q1 FY26, in terms of capacity addition, 11 gigawatts, which is more than double of what we did last year.
Mr. Rastogi, numbers would help, sir. It just focuses the mind.
Yeah, so, unfortunately, I can't give you any guidance in terms of numbers for us as a company policy, but we have a very, very healthy order book, as well as a discussion pipeline with the customers for future orders.
Have we seen the let me put it another way, at 30% EBITDA margins, is that a bit of a ceiling? And we kind of, same time last year, the EBITDA margin was 16%. 16 is now 30.
Correct.
Right? So, what should we expect? Direction of travel?
So I think the direction of travel, as far as we can see, is pretty encouraging and near the current levels. We have an order book already signed in place for next year's production, which is nearly at the current margin. So I think we expect the visibility at these current levels to stay for some time.
Okay, all right. Hi, Mr. Rastogi. Good to see you, Ben. The cell capacity has been coming on stream. I think in this month, there was another capacity that came on stream for cells, or it's due to be coming on in the coming months. Tell us, out of the total cell production, how much of it is consumed in-house and how much of it is sold to third parties?
Yeah, sure. So you're right. Our new cell line has come online. It is one of the most advanced cell lines in India right now. We consume part of the cells in-house and partly sell outside to other manufacturers. And that ratio, it tends to vary from quarter to quarter. But very broadly speaking, we try to maintain the ratio at about 50-50 levels.
Okay, all right. So 50-50 levels. And as you get backward integrated, then will that be an additional reason for margins to go up from here on? As Prashant just said, you were doing teens, you're gone to 30%. But as backward integration comes about, is there scope for further margin improvement, or you'll be satisfied at around this 30% ballpark?
So, I would say two things. One, we are integrating backwards. So a lot of the raw material that goes into solar module production, we will start making ourselves. So that will definitely help the margins go up. But the second equally important factor is that, we are moving the policy framework, moving towards more and more value addition in this space, which means customers are mandated to buy in India, and the share of Indian manufacturers as a result in the whole market is also expected to rise. So overall, because of these two factors, like I said, our margins should be very stable, and if anything positive because of the backward integration.
Okay, all right. I just want to take that point forward itself, because you've mentioned in your con call as well, you want to focus on India. Exports has come down to 1%, and that's not a focus area. Previous quarter, I remember it was around 6%. Now, if you're saying that, Indian producers, Indian manufacturers will gain a greater chunk of the market share, what is it currently, if you could give us a rough number, and what is the opportunity then?
So, this year we expect the Indian market at about 40 gigawatts, out of which imports will account for about 15 gigawatts, and the rest would be the Indian manufacturers. So we are talking about 25 gigawatts out of 40, which is a market share of about 60%. In 2 years' time, this 40 gigawatt market size is expected to go up to about 50-55 gigawatts, with the entire share coming from India. So, which means the share of Indian manufacturing is going to actually, or the absolute volume is going to double in size over the next 2 years.
Vinay, finally, just very quickly, apparently cell prices in China have picked up in the last 2-3 quarters. Some reports suggest they're up 30%. Correct. Can you just tell us if that has any second order effect here on pricing in India? What is generally happening with cell pricing here, modules, and just, how you see the next couple of months shape up on this?
Yeah, sure. So, what is happening in China very quickly is that the Chinese companies have been selling below cost. They've been dumping their products because they have so much oversupply and overcapacity, which was not sustainable. So I think they've had a lot of pressure and the prices have started going up finally. The good news for us is that the Indian market is pretty insulated from what is happening in China, partly because of the government of India policies and also because of all the investments that we have made in our own capacities. So I think, we don't see, there is temporary, some minor adjustments that we have to make in terms of our purchases, timing of our orders, etc. But by and large, our pricing and our profitability remains intact and insulated from any movements in China.
But can you demand higher pricing for what you're selling outside, not the captive use, but outside? Do you see higher sell prices in India?
So yes, I mean, currently the sell prices in India are higher, but that is again, depends on what you're comparing it with. If you're comparing it with China, I would say that is not a true benchmark because the Chinese companies are selling below cost.
Yeah, absolutely. It's interesting, and maybe next time we'll press upon that. You said EBITDA margins should be, we should be able to hold on to it for some time. So that for some time is the question. Thank you very much, Mr. Rastogi. Appreciate you joining us, and good speaking with you here on CNBC-TV18. Good luck. We take a quick commercial break here. Manisha Gupta joining us on commodities. What's top of her mind coming up in just a bit.
Welcome back. Well, we've got Mitesh joining in. Mitesh, good to get you back. So what are the trades now? Recovery from the lows?
That's right. And, as I said, we might not drop much below 24,500. We actually got a low of 24,598. So I think this is the area where, medium-term and weekly supports start kicking in. And the put-call ratio was also getting close to kind of oversold levels from where we have seen some kind of bounce back. So I think maybe in the short term, you will not see much of a traction on the downside unless until we start breaking below 24,500, 400 zones. Having said that, I have a buy on Alchem Labs. That's a stock which is making a fresh swing high. So keep a stock below levels of around 50-50, maybe 50-40. On the upside, look at targets of 51.30 or thereabouts. And the other stock which I like, that's Cipla. I think Sudarshan had given that call as well in the morning. After a good rally, the stock has been consolidating for last few hours, but looks like there will be a continuation. So 1548 is the stop was recommended and 1625 is the target.
Okay. All right. Got it. Mitesh, thank you very much for that. Let's quickly shift the focus to the commodity markets. We have Manisha joining in with the latest. Manisha, good morning.
Morning, and thank you for that, Surbhi. I'm talking about the crude oil prices because we've seen strong gains overnight come in for this one. The first part of the week wasn't so strong, but we've seen 2% of gains overnight, and with that, we are trading at a one-week highs for the crude oil prices. The latest trigger clearly comes in from US, which has shortened the ceasefire deadline for Russia. Now, the US President Trump released a statement yesterday saying that Russia has 10 to 12 days now to agree on a ceasefire or face further secondary sanctions as well. Remember, it wasn't too far back that European Union also released an 18th package of sanctions on Russia, and this time around it has been on oil and energy. We have seen sanctions come in on in sense of price cap. There also are individuals and institutions which also are now facing restrictions, and apart from that, apart from the cut in the price cap as well, total 400 ships, shadow and direct, have been sanctioned now. So this really does impact the flow there. And we also have a JP Morgan report in the meanwhile suggesting that the further US sanctions, if implemented on Russia, could lead to a supply shock as the OPEC Plus does not have that kind of a spare capacity, and that led to premium in case of prices there. Well, the support also comes in from the fact that we're looking at various tariff records now coming in. US has seen tariff agreement with Japan, UK, Vietnam, Indonesia, Philippines, and that seems to be supporting the risk sentiment and the belief that you could be looking at demand growing going further. Of course, there are deals on table as well. You still have China. The conversations for that started on Monday, and then you have Mexico, Canada, India. These deals still on the table there. The support also comes in after the OPEC report, which says that they are looking to pause further production increase from the month of October. Remember, OPEC has been increasing production from the month of April, and they are doing it until the month of September. October could be a pause, and that clearly is supportive for prices. There also is a statement from IEA which says that the global inventories have been increasing and accumulating at a rate of 1 million barrels per day, which is 1.5% of total global consumption. Markets looking at this number as well. And then finally, it is about the US crude inventories, which we have seen continue to decline quite sharply. The US crude inventories right now are at a 4-year lows, and they are 18% below the seasonal 5-year average as well. Not just the US crude inventories, the distillate inventories are also more than 18% below seasonal 5-year average, some of the factors which clearly seem to be in support for crude prices.
All right, Manisha, thank you very much for that. So oil in focus. We'll take a quick commercial break here. We get chatting with the management of Bank of Baroda on the back of their first quarter performance. Lata will take you through that conversation with Mr. Devdatta Chand coming up in just a bit.
Welcome back to our earnings corner. Bank of Baroda's first quarter results were a mixed bag. Very resilient net interest margins, but higher slippages due to an overseas loan and a slight uptick in personal loan NPAs. But the net interest margin was the cynosure of everyone's eyes. It fell by only 7 basis points. Remember, for many private banks, the margin has fallen by between 15 and 25 basis points. But can the margins see lower levels now in the current Q2 and in Q3 because of the rate cuts? Also, can loan growth maintain this 12 to 13% run rate that we saw in Q1? For all these questions, I'm joined by Mr. Devdatta Chand, Managing Director and CEO of Bank of Baroda. Good morning, Mr. Chand. Thank you very much for your time. Well, first up, it is the margins question. You all controlled it well in the quarter gone by, but will it take a bigger chunk in the current and next quarter? Have you any estimates?
Thanks, Lata. Good morning. And as far as the margin is concerned, it is typically because of the rate transition that is happening on the economy. And as you said, right, that the book has shown a resilient in terms of the margin cut as far as Bank of Baroda is concerned. So going forward, what we see that major part of the repricing, the full quarter impact we are going to see in the next quarter, that is Q2. And this quarter, the full impact has not come. So there can be pressure. At the same time, on the deposit side, we are seeing significant repricing. That means the interest expenses is going to go down for the next quarter. So net to net, there would be impact, but we are not looking at a significant impact on the net interest margin in next quarter. That's why the full year guidance we are giving at 2.85 to 3, with a quite bit of hope that Q3 and Q4 will be much better than the Q1 and Q2.
Okay, so you're expecting the recovery in Q3 itself. Q2 you think will be at the bottom?
Yeah, that's right. Q2 would be the major impact Q2 would take, but Q3 and Q4 would be much, much better.
Okay. Well, the other point is, of course, on slippages. There is, of course, as you pointed out in the investor presentation as well, that there is one international account, but there was a bit of pain in the personal loan account. Can you take us through the slippages picture and how it has evolved now? You're already 2 months down in the second quarter. Can you give us an idea of how slippages might pan out sector-wise?
Yeah, as far as the slippage is concerned, even if with the international account, we are well within our guidance range of 1 to 1.25. And because this international slippage is one-off, so excluding that, the slippage ratio would be at 0.99, which is comparable with the slippages we have seen in the earlier quarter. Our normal run rate on slippage per quarter is roughly around 2,800 to 900. So in that, the bank is well within the slippage guidance, and excluding this one is all comparable with the earlier quarters. Saying so, on the personal loan, on the legacy book, we have seen some 100 of crores slippage, but in terms of slippage ratio, because the denominator is also increasing, the slippage ratio is well within the comparable parameters with the earlier quarters. So we are not seeing any elevated level of slippage going forward. On the collection efficiency is much better now. The credit book looks very, in terms of the SMA 1 and 2 looks much better now. So we are not thinking of the asset quality of the bank is quite robust and resilient enough to take care of any impact because of the slippage going forward.
No, I'm not saying that you will be in trouble at all, sir. After all, you'll have historically low NPAs of 0.6%. There's no question of any problem. But what I'm asking is that, is there any vertical, for instance, unsecured personal loans or MSMEs, or any, international book where you may see pain? Have you already noticed in the first 50 days of the current quarter?
Yeah, as far as international book is concerned, again, the asset quality is quite good, and this particular account is a one-off clearly. So other than this, there is absolutely no other account which has any sickness as on today. Secondly, on the domestic book, only on the retail advances, we have seen some 150 crore of additional slippage as compared to the last quarter. And precisely as I said that because of legacy personal loan book, the slippage has been there. But as a strategy, earlier the personal loan used to grow at much higher pace of 30, 40, 50%. We have moderated to 20% this quarter. And I don't think, this additional slippage is because of the legacy book. On the current book, absolutely no stress therein. So, but in case you compare the slippage ratio, then it is well within our earlier quarter slippage on the personal loan.
Okay. Just one number came to my eye when you have a page in your investor presentation which says that the MSME loan NPA was the highest. It was 10,600 crore. In everything else, it is, the next big is agriculture, which is 7,000. Then is retail, 5,000. MSME 10,600 is standing out. Is that likely to give you any trouble at all?
No, not. See, MSME, there are a percentage of this outstanding is again because of different government scheme. The government guaranteed they are in the credit guarantee coverage is there in those NPA outstanding.
Oh.
So, but at the same time, if you look at the slippage ratio for MSME, because the MSME growth last year was 14%, and this quarter it is almost at 12.4%.
Yeah.
Considering that the denominator is also increasing. So, what is important here to take note of is a slippage ratio. In terms of ratio, we are not exceeding our earlier slippage ratio in MSME.
Okay. Yeah, there is a 13% rise in MSMEs and 17% in retail. Yes, but 13% is a fairly robust number. Let me come to credit offtake. Credit growth on the overall number looks very good, even if it is a Q fall. That is to be expected. After all, the March quarter tends to be very strong. And with the start of the monsoons, Q1 does not match up to Q4. But can you repeat a 12% growth?
On the overall advance, absolutely. Our guidance is 11 to 13%, and this quarter also we're at 12.6% on the advance growth. So only the RAM segment, which is retail, agri, and MSME, almost growing on an organic book 18%. So that's significant. At the same time, the corporate, typically the first quarter of the year, we do a bit of realignment. What I mean by saying that, because we have reduced the bulk deposit to the extent of 23,000 crore. So obviously the fine price asset typically because there is a repricing happening, so we could not do those transactions. So the corporate growth is 4.2%. If you compare the corporate growth of 4.2% vis-a-vis the last year, the same quarter, that was at 2.5%. On a full year basis, we could achieve around 9 to 10%. And we are hopeful also this year that on the corporate also we are going to have something around 9 to 10% for the full year. Saying so, the RAM continued to be the growth driver. And this time the RAM growth is almost 18%. But I expect at least a 15% growth for the full year on the RAM side also. So RAM growth of 15%, corporate growth of 10% typically would put us into around 13% growth on the advances side.
Okay. I hope you know that you are on the higher level in terms of guidance. Practically no one is guiding 13%. On the street, certainly not the private sector banks. They are closer to 10. What's the likelihood of the ROA going down in the current quarter? You are very close to 1%, and there are a few people out there who worry that it may go down below 1 because the NIMs will be under pressure. You think so?
So look, the ROA has been in excess of 1 for last 12 quarters now.
Okay.
So a scenario that where the bank is actually the book is quite resilient in terms of both profitability and also growth on the top line. So the full year guidance, again, we are giving that the ROA has to be more than 1. I mean, the quarters where the NII is slightly bit a challenge because of the interest rate transition, we're able to optimize on the other income or the non-interest income.
Okay.
So going forward, I think we'll be in a position to maintain our guidance of above 1 ROA for going forward.
Okay.
As you talked about the ROE, as the bank is generating enough profitability, so ROE is almost at 16%. So going forward, again, when you grow, because I believe there is enough opportunity in the market for us to grow, then the ROE also is going to have it is currently very strong and going to be strong. I'll just give you a few of the bank's book. Look, one of the key piece of the bank's entire book is the way the liability management has been. At a cost of deposit of 5.05, at a CASA percentage of 39.33, at a domestic NIM of 3.06, I think the bank book is well positioned to capture all the opportunity that the market offers. At the same time, also, in case any headwinds because of the geopolitical scenario, also the bank book is quite capable of handling it.
Okay. Okay, fair enough. I'm not doubting that. And even if there is a dip, it is expected only for 1 quarter, not for the full year. The other issue I wanted to know is that, in your various meetings that public sector banks have with the government, is there any move to remove that 20% cap that FPIs have? It is not serving any purpose. They will buy what they will buy, irrespective of whether they are allowed 20%. Because of that, IIFL has made a calculation that SBI is losing some 1.4 billion of passive inflows. You are losing some $200 million of passive inflows. Is there any discussion at all that this cap, that sentence is just dropped?
Look, as far as Indian banks are concerned, going forward, let's say we talk about next 5 years or 10 years, banks would require capital. So, that's something we require it. But with the FDI cap, it's a policy issue which the stakeholder would take a call. Obviously, the data you are presenting is known in that way. The stakeholder would take a call with regard to that. But as far as banks are concerned, definitely going forward, although our CRAR is quite comfortable as on today, and that can take care of our requirement for going forward. At the same time, on a 5 years or 10 years horizon, possibly bank would require capital and possibly the call would be taken at the right time.
Yeah, fair enough. One hopes. I know this is a question to the finance minister and not to you, but I was only wondering if it comes up in your discussions. Just a final question. Are you all tapping the capital market in any way? Either sale of your stakes in any of the subsidiaries or even holdings like NSE. Or even raising capital for your own sake. Look, your competitor, State Bank, has raised 25,000 crores. The market is kind to banks who have done well. Any way will you approach, either for your subsidiaries or for yourself, either for selling or for raising?
So there are two aspects here. One aspect is your own capital raise. We had announced to the market earlier that on a medium term, we intend to raise roughly around 8,500 crore of equity that we already announced. But at a time where it would be required for us to raise. So immediately there is no plan as on today. At the same time, on the monetization of the assets, subsidiary asset, already there is a plan. But again, all this monetization depend upon the right valuation, which is again one of the important factors for us to consider. So a couple of our assets like subsidiary, the divestment or the IPOs are in the pipeline. We are discussing also how do we again come out on that. So that would continue, like the moment we get an opportune time, we'll keen to monetize that. But as far as bank's own capital is concerned, as on today, we are well capitalized. At the same time, yes, there is a plan to raise capital in a medium term, not immediately. But you are right that the market is kind. At the time, we'll take a note of that and then decide on the matter.
Yes, the market is certainly kind. Your stock is in the green, though Bank Nifty in general is not doing too well this morning. Thank you very much, Mr. Chand, for joining us with your thoughts. We leave the market in kind of cautious optimism, if you please, although at the moment I should say cautious pessimism. Stocks across the board, the indexes are in the red. Mid-cap is about a little better than the rest. Let's see if after the first hour of caution, the market perks up. Wrap up on Bazaar chart busters coming up.